In this presentation, we will discuss an adjusting entry related to an invoice that was entered in the wrong time period. First, we'll discuss the problem. In the following presentation, we'll discuss the solution to it. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to open up our balance sheet. So we're going to go down to the reports on the left. We're going to be opening up the balance sheet report. So we're going to open up the balance sheet, our favorite report. We're going to go back up top with it and put in the dates of 01/01/20 to 02/29/20. And then we're going to run that report. I'm going to duplicate the tab up top. We're going to go to the tab up top and duplicate it. Then we're also going to be opening up the profit and loss. So we're going to go back to the tab to the left. I'm going to open up or go down to the reports first. Then I'm going to open up the P&L, the profit and loss, the income statement. Going to change the dates up top for it. We're going to scroll up top to do so. The dates are going to be 01/01/20 to 02/29/20. That being our cutoff date, of course. Going to duplicate that tab by going up top, right-clicking, and we're going to duplicate the tab. I'm going to close up the hamburger, make this a little bit larger, bring it up to 125. Now here's going to be our problem. We're going to say that there was an invoice. The invoice was entered in March, but it should have been entered as of the end of February or in February. And this you can think of most easily as happening if you're talking about like a service company, if you're talking about like if we had our guitar services that we would have and we had to collect the information in order for our guitar instructors. We have to get their billable information, their billable hours, then send out the invoice. That would be similar for a law firm or an accounting firm, where we basically take the billable hours and send out the invoice, which we might do weekly, every other week, monthly. In that case, you can think about the situation where, well, what happens if we send out the invoice in March, in our case, but all the work was done in February, right? All the billable hours that were given to us possibly were done in February, but we had to add them all up and we entered the invoice into March. And that means that technically, when does QuickBooks record the revenue? When the invoice is done. QuickBooks will record the revenue when the form is generated, the invoice. And that's not perfect accrual accounting. QuickBooks is just using the best thing it has. That's the best form it has in order to record the income. But we entered the invoice at a later date than when the work was done. On an accrual basis in that case, we should have entered the revenue when it was earned, when they gave the guitar lessons in February, even though we didn't get around to adding up the hours for that work that was done in February until March and then creating the invoice with it. So that's what we're going to do. First, I want to put in an invoice and we'll make that invoice for February. And then we'll bring it back. Now I'm going to make it a little bit more complicated than just a service item, because a service item we only have to deal with the recording of the sales and the related accounts receivable. I want to think about an inventory action as well. So when we sell inventory, it's probably a little bit less common that this would happen, that you have inventory, because usually the shipping document is kind of when things take place for inventory. In other words, when did you actually earn the work? When you ship like a guitar, when the guitar has been shipped, if it's FOB, shipping point, or destination. But basically when the guitar's out of your hands and in the possession of somebody else, it's left the facilities, that's when you've completed the work. Now it's possible for that shipment to have happened and possibly the invoice not happening till a later time period. This is also, so in other words, the guitar went out and therefore you should record the sale in February, but the invoice wasn't actually processed till March. And this is also kind of an auditing type of procedures that's often going to be done. People are going to be worried about the cutoff period, because if people were trying to manipulate the numbers to look better or worse, better for bookkeeping purposes, for financial reporting purposes, possibly worse for tax purposes, one of the things they might do is manipulate basically the timing difference of when revenue is going to be recorded. How would you do that in QuickBooks? How would you manipulate when the revenue was going to be recorded? You just wait until you enter the invoice, right? You could say, well, we did the work in February, but if I don't want to record the income, possibly for taxes in February, then if you waited and didn't record the invoice until March, then you basically push the income out to March. And then if you wanted more income in the current time period for financial statement purposes, possibly, you'd have the invoice in February when you didn't actually complete the work until March, right? So that's going to be something that in an auditing process people are concerned with. But oftentimes it's something that just happens naturally, especially for service companies that just invoice every other week or every month or so. So first we're going to enter that invoice. I'm going to enter it after the cutoff date in March so you can see the actual invoice. Next time we're going to take that invoice and we're going to basically pull it back with an adjusting journal entry into the current time period into February. So let's go to the first tab then, and I'm simply just going to make another invoice. So I'm going to select the plus button. I'm bringing it back down to 100% so it doesn't do anything funny, of course. And then I'm going to go to the invoice. So we'll open up an invoice. I'm going to say that the invoice is going to be going to Anderson. So it's going to go to Anderson, and we'll tab through here. And the key point is that the invoice date is going to be 03. Let's make it 0305 20. So it went out in March. That's the key point. 5th, March 5th. Due date here 4/4. That's fine. Then the product that we sold, we're going to sell a few. We're going to say that we had an an Epiphone semi-hollow body, which is an ESH, and we're going to say that we sold 2 of those. So I'm going to say 2 of those, and it is a taxable item that should be populating. And then we also have an ELP that we sold. We sold an ELP as well, and we're going to have 1 of those. So that comes out to a total of 1,300, and that gives us then the sales tax of $123.50. And that gives us a total of $1,423.50. So let's just think about the invoice again, because this will give us a nice clean invoice that we'll look at in March, so we can really look at what the invoice does and the accounts that will be affected for it. So what's going to happen when we send the invoice? Well, accounts receivable is going to go up. It's going to go up by the $1,423.50. Then revenue is going to go up, but it's only going to go up by the $1,300 that we get to keep. The difference, sales tax, 123.5. That's going to go into a payable, basically sales tax payable with QuickBooks puts into the vendor name of California Department of Tax, whatever, something. Then we know that the inventory is going to be going down by the cost, which isn't on this report, the cost of these 2 items and this 1 item. And the cost of goods sold is going to increase on the income statement, and it's going to be decreasing the net income for that amount. So let's go ahead and say save and close and check that out. So we're going to save it. I'm going to go back up top. If we take a look at the balance sheet, I'm going to close up the old hamburger and scroll up a bit. The hamburger didn't close. The hamburger doesn't want to go away. So then I haven't refreshed, but once we go into the accounts, that should refresh for us. So I'm going to go into the accounts receivable. And if we scroll then down, we have, it's not, hold on a second. Let's go back to the prior report. I'm going to change the date to March, right? March, let's just say 5th or even 10th, or sometime after the 5th of March. Then run the report. Then we can go down to the accounts receivable, and we should be able to see this transaction. If we go down, we have the invoice that happened in March. So there it is. Obviously, if I opened it up, I'd go in there. That'd be for the full amount. I won't do it again because we've seen many invoices at this time. But the other side is going to be in the P&L, profit and loss. And it's going to be in there in March. So this is where we get to see what's happening on the income statement very clearly with an invoice. I'm going to go 03, 01, 20 to 03 like 10, 20. So March 1st to March 10th, 2020. Run that report. Now this only has basically our items related to the reversing items are there, but also our item for the invoice, which is going to be the sales. There's the 1,300. So there's the 1,300 for our invoice. Notice we have the 2 items for the invoice on it, but they were both on the same invoice for that 1,300, and that's for the amount not including the sales tax. Back to our income statement or profit and loss, the sales tax on the balance sheet, back to the balance sheet. It's in the liabilities section. So if we go down to the liabilities section, it's in this California Department of Tax and Fee and so on and so forth would be there. We also know that the inventory is going to go down. So inventory is going to go down. So I'm going to go back up top and say inventory went down, and it went down by, if I scroll down to, they put it in the 2 amounts for the 2 items on the invoice by the 640 and the 400. So, and that amount isn't on the invoice, but it's driven by the items on the invoice. The other side then being on the profit and loss, and cost of goods sold. Cost of goods sold then has those two items again for the same invoice for them. And again, for those amounts that aren't on the invoice, those are the cost of the guitars. Going back up top. So there we have that. Now the problem here is that on the income statement and on the balance sheet, but we're concentrating kind of on the income statement for the accrual basis. When was something recognized? It was recognized here in March. It should have been recognized in February, we're saying. So in other words, we shipped the guitar in February. So we need to pull then this income and this cost of goods sold to the proper time period, which is going to be February, as well as represent the related balance sheet accounts as of the proper point in time of February 29th. So how are we going to do that now? That's going to be the problem, right? Because what we could do is basically, we could go into this invoice and change the date on it. That would kind of be the cheating type of way of doing it. But we don't really want to do that because we want to keep the actual invoice date. One reason we don't want to do that is we want to keep the actual invoice date. It might have been tied to a purchase order, and we also, if there's been basically a payment on it or the terms that are on it, the 30-day terms, we want to keep those in place too. So we're not going to go in and just change the date of the invoice. What would typically happen in a reversing entry then is we would go in with a journal entry and we would have to do the reversing entry. So we're going to reverse this in next time. We're going to do a journal entry and reverse this out into March, which means we're going to have to do just what we did, like look at each of the accounts, actually look at the journal entry, write down the journal entry, and then reverse that journal entry and put it into the books as of March 29th. So that'll work. That'll make the financial statements correct as of February 29th. That'll make the financial statements correct as of February 29th. Our cutoff date will be right on an accrual basis as of that time period. However, you might see there then that there would be a problem because we would have entered it twice at that point. So it's already entered in March as of March 10th. So once we get up to March 10th, then it had been entered twice. We've got it in there 2 times, and that'll be reflected on the balance sheet and show here. So what are we going to do? We're going to reverse it as of March 1st. So we're going to pull it back in with an adjusting journal entry that reflects basically an invoice. And then we're going to reverse that whole thing as of March 1st. And then it'll all clear out and be back to where it should be as of March 10th. And the only difference would be a timing difference that we needed to do in order to get the financial statements correct on an accrual basis as of the cutoff date.